With the current high interest rates, many more people need to think about paying tax on their savings income. My name is Helen Thornley and I'm a Technical Officer with the Association of Taxation Technicians, ATT for short. In this video, I will look at what you need to know about tax if you have savings. This video is intended as information and does not constitute advice. It is based on the tax rules as at February 2024 and applies to UK residents only. If, after watching this video, you want specific advice on your situation, you can find an ATT member to help by going to att.org.uk and searching under Find an ATT. Let's start with some background on savings interest. For many years, banks and building societies used to deduct tax from interest before they paid it over to you. For every £1 of gross interest you earned, 80p was credited to your account, the net amount, with the remaining 20p paid directly to HMRC as tax. Since 2016, banks and building societies have paid interest gross, without any deduction of tax, and individuals have been allowed to earn a certain amount of interest each year tax-free. This tax-free sum is called your Personal Savings Allowance, or PSA. The size of this allowance is dependent on your income. Individuals with a total income, including interest, of less than £50,270 in the 23-24 tax year are entitled to a PSA of £1,000. That means such people can receive up to £1,000 in interest before they have to pay tax on it. If your total income exceeds £50,270, then the PSA is halved to £500. Once your total income exceeds £125,140, you do not get any PSA and have to pay tax on all of the interest you receive. The only interest that is never taxable is that earned on savings held in an ISA, an individual savings account. When adding up your interest, you can ignore interest from any ISAs. To add to the complications, if you earn less than £17,570, then you may be able to benefit from a special 0% starting tax rate for savings, in addition to your PSA. I won't be covering that here, but you can find guidance on the website of the Low Incomes Tax Reform Group at litrg.org.uk. There's a link to their site in the description below. Once you have worked out what PSA you are entitled to, you need to work out how much interest you have received during the tax year. If you ask, your bank should provide details of the interest you have been paid in the tax year, or you might find the information you need in any banking apps you use. Add up the interest from each of your accounts, excluding your ISAs. This should give you your total interest income. This is a boring task, but it's also a great time to check if your money is working hard for you and you are getting the best interest rates. You should include interest from other sources in addition to your bank and building society accounts. Interest can be paid on investments such as unit trusts, bonds, and on refunds of payment protection insurance, called PPI for short. Unlike interest from banks and building societies, you might find that tax has still been deducted from these sources. If that is the case, add the tax figure to the net interest you have received to calculate your gross interest. Also, keep a note of how much tax you have had deducted. If your gross interest income is less than your PSA, but you've had some tax deducted, you may be able to claim some or all of that tax back. Once you've done all this, if your total interest exceeds your PSA and you think you might have tax to pay, what happens next depends on whether or not you are in self-assessment. If you are already in self-assessment and completing a tax return, you should already be adding up and reporting your interest each year. When you report your interest through your tax return, this will calculate if you have any more tax to pay. If you don't otherwise need to be in self-assessment, but think you have tax to pay on your savings, don't worry. You won't necessarily have to register for self-assessment and complete a tax return. HMRC's guidance says that you only need to register for self-assessment on the basis of your savings income if you earn more than £10,000 a year in interest. In a lot of cases, HMRC will sort out your affairs automatically because each year the banks and building societies will report the interest they have paid directly to HMRC. As long as HMRC can match details from your bank or building society to your tax records, they can use details of employment or pension income received from your employer or pension provider to calculate your tax. HMRC can ask for any extra tax in one of two ways. In the first instance, they can issue a tax calculation letter called a P800. Any tax you need to pay will be deducted from future salary or pension through an adjustment to your tax code. Alternatively, HMRC might issue a simple assessment. If you receive one of these, you have 60 days to contact HMRC if you do not agree with it. You must usually pay HMRC by the 31st of January following the end of the tax year to which the assessment relates. These calculations are usually issued between July and October each year, so you won't get a demand for tax straight after the end of the tax year on the 5th of April. Whichever you receive, it's important that you check the interest figures that HMRC has used. Sometimes HMRC's figures can be wrong. Problems can arise if you receive interest from a joint account, if HMRC includes estimated amounts from previous years, or if figures have been duplicated. So always check what HMRC tell you and ring or write to HMRC if you disagree with the figures they have sent you. You should also check that any other figures on the calculation, such as for employment or pension income, are correct. Let HMRC know if any of the figures are wrong or if any income is missing. If you don't, then you may not pay the correct tax. Contact details should be on any letters you receive from HMRC. For those not already in self-assessment, HMRC's current advice on savings income is to wait for them to contact you after the tax year. HMRC should tell you if there is tax to pay. However, if you think you have tax to pay and HMRC has not got in touch with you, then you still have legal duties to tell HMRC you owe tax. Strictly speaking, you should let HMRC know by the 5th of October following the end of the tax year if you have any tax to pay. If you are concerned and you haven't heard from HMRC, you can proactively report your interest details to them. Go to gov.uk and search for Contact HMRC and click on the link for income tax to see all the ways you can get in touch with them. When you contact HMRC, you will need to provide a full breakdown of your interest income for the relevant tax year on an account-by-account basis. This allows HMRC to cross-check your figures to those already provided to them by your bank or building society. While we hope that the number of people who fall through HMRC's net will be small, it is worth being proactive to make sure your tax affairs are correct and complete. You don't want to get an unexpected brown envelope demanding tax a few years down the line.